Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show. Welcome, everybody, back to the DIY Wealth Canada podcast. I'm Nelson. I'm here with Bob. And this week we have a episode that will maybe hopefully put the brakes on for some of you. We're going to talk about managing risk. We're going to talk about some of the crazy strategies that are out there people are using to try to get rich in a hurry, and just how dangerous we feel that is for the average retail investor. Ultimately, this is the DIY Wealth Canada podcast. It is not the woo degenerate, let's go crazy and try to get rich in a hurry podcast. So obviously we have some thoughts on this, and some recent market developments have just really left us concerned for kind of the next generation. So Bob, are you ready to kind of throw cold water on a lot of the crazy strategies that perhaps young people nowadays are using to try to get rich in a hurry? We're probably not going to make any friends with this episode, are we?
No, for sure. Absolutely. I think one thing to know, like what you said, Nelson, is building wealth takes time, takes a very, very long time. You probably have heard about people saying the first 100K is the hardest, and then it gets easier and easier. Like if we look at our investing career journey, financial independence journey, absolutely the first 100K was probably the hardest, and then it picks up speed and things just compound quicker over time. A very good analogy, I think I may have used it before, is it's kind of like rolling a snowball down a hill. Right? Initially, the snowball is really small, it's rolling slowly, and then as it gets bigger, it picks up speed, it picks up more snow, it gets bigger and bigger, and that's essentially what it's like, right? So if you make your first 100K, say it takes, 5 years to get to 100K, maybe 200K takes less than 5 years, and then just compounds from there. Right? And that's certainly something we have seen with our investment portfolio. It just picks up speed faster and faster. And obviously, as you get with your portfolio getting larger, a drop of 1% or 2% in the market become a pretty significant dollar amount. And that's just the reality of playing with a bigger number in your portfolio. Yeah, very excited to talk about these crazy investment strategy or very, very high risk investment strategies. And we also want to talk about how do you manage your risk. Like, we're not saying don't never go use these strategies. It's all about, if you decide to deploy some of these strategies that we talk about, how do you manage your risk so you don't lose all your money with one of these risky strategies?
That's exactly it. Ultimately, you have to take some risk in order to get wealthy. It's just a reality of the financial markets. Sometimes financial markets will go down, and even like non-risky assets in the financial markets. Like at the end of the day, the stock market is filled with everything from ultra safe to ultra risky plays and everything in between. And even, concentrating your portfolio on maybe the safer side of the market, you're still going to see in your lifetime a few downturns of kind of 30, 40%, and even once or twice, probably 50%, where that's how much stocks are going to go down. And that's even if you keep things on the relatively safe side of the spectrum. On the sort of the riskier side of the spectrum, you can see 80, 90, 95%, even 100% drawdowns if you're not careful about that. So that's a reality of the markets. But at the same time, we're really here today to try to help you keep it on the happy side of not blowing up, essentially, which is a good segue into kind of the first thing I want to talk about, which is a few weeks ago, Bob, we had this kind of 3% decline in the S&P 500, and that there's a lot of people on social media, on Twitter, on Reddit, Wall Street Bets, which I go to kind of have a good chuckle at some of the strategies that people are using. There are people who saw this drawdown and this 3% decline on the S&P 500 was really, say, like a 10 to 20, 30% decline in the crypto market, because the crypto market is much, much more volatile than the rest of the market. And what we saw was that one downturn had people who blew up their whole portfolio. And my question is, and I don't even know if you know the answer to this, but my question is, how in the hell is that even possible to do that? What kind of risk strategies are people using if one down day that isn't really that bad of a down day can blow up their whole portfolio? I'll never understand it.
Yeah, it's crazy. I mean, you and I have probably invested over 20 years, right? Like we started early, so yeah, I'm probably around 20, 25 years of DIY investing right now. I think Nelson, you're similar, maybe longer. But I think the S&P dropped by 2.7%. NASDAQ there a little bit worse. I think it dropped by 3.6. Right, TSX was better. I think it was only like 1.5, 1.4%. And people were freaking out, like as if like they're losing their mind. Like, I don't understand. Sure, if you look at the tech stocks, right, like NVIDIA dropped quite a bit, and basically the FANG stock all dropped significantly. And I mean, I work for a tech company, so our company stock didn't feel well either. I think it dropped by almost 7% on that day. But like, it's not like 10, 15, 20% that we're talking about. It's less than 5%. So I don't know why people are losing their shorts on this. And some people are talking about how they lost significant amount of money, or even if you look at the Bitcoin or crypto side, some people are saying they liquidated everything, which is absolutely insane. So I think if I sort of just do a rough calculation, I'm assuming a lot of these people are investing on margin. What do I mean by investing on margin? Basically, they're borrowing money to invest. So maybe they're borrowing, 50% of money to invest, or even more. And when things are going well, yeah, you're leveraged. So you're getting more than, say the market returns 10%. If you're borrowing 50%, then your real return is 20%, and it goes up from there the more you leverage. But on the flip side, when the market goes down, if the market goes down, say like recent weeks, market goes down by 3%, your portfolio also drops down. So you leverage, one time, then it's 6% and multiply from there. And the danger of borrowing to invest is you may trigger margin call on a bad day, right? And that's when your broker could liquidate everything that you own, cover their own rear end. Nelson, do you want to talk a little bit more how margin call works and why it's terrible when the market kind of gaps down?
So a market or a margin call it's very simple. It is there's a certain margin that you have to maintain. And once that margin is no longer maintained, your broker forces you to sell everything at the then market price. So what that does is there's a couple of reasons why that's terrible. And one is, of course, is that you're pretty much guaranteed, if you're not selling at the bottom, you're definitely selling below the highs. And of course, that's investing 101 is buy low, sell high. Well, you don't want to sell low, and the margin call forces you to sell low. And the other thing is that the margin call has, like, there's no analysis into it or anything. It's a forced sale. And often what happens is that the person who is forced to have sold, in 1 week, even 1 day, when these assets recover, well, they don't get that recovery because they've been forced to sell at the inopportune time. So my advice for margin is twofold. One, keep it reasonable. If you do insist on doing it, keep it reasonable. one of the things we've seen in the crypto world is that the exchanges are willing to give massive margin for certain products at certain times, and that's just asking for trouble. And to be honest, I don't understand why the exchange is doing it either, because crypto is such a volatile asset that you just get one down day and you wipe a bunch of people out. And when you wipe people out, oftentimes the exchange doesn't get paid everything that they're owed. So I don't understand what the thought process is. But the point is that just protect yourself, keep it reasonable. And my advice is that if you do dip into it, the thought process, my thought process for margin, I don't use margin anymore, but when I was younger, I did, in terms of I borrowed money to buy property and so on. So I was comfortable with debt. But my philosophy now is you have to come up with a strategy while you're clear and sober and you're not influenced by anything. And that strategy might be, say, the TSX composite falls 20%. I'm going to dip into my margin at that point because I think it's a good buying opportunity, rather than running with margin all the time, which really is risky when the time comes to potentially liquidate that. Bob, have you ever used margin? Are you a borrow to invest guy? I don't think you are you?
No, we have never borrowed to invest. And just to add to what you said, Nelson, I think if you want to borrow money to invest, borrow strategically is fine. It also depends on what asset class you're investing in, right? Like when you think of people leveraging or borrow to invest, you're thinking, crypto, even like Tesla a few years ago, Nvidia nowadays, where all these stocks or assets are very, very, very volatile. So, your Nvidia, your Tesla could go up, 5%, 10% a day, and also goes down like 5-10%, right? And with crypto, we see bigger volatility, and that's the part that could get you in trouble, right? That's when margin calls are initiated. So maybe if you're leveraging, you may want to play a little bit safer and investing in some safer assets that may not have as big of a swing. Now, obviously, you wouldn't be able to make as big bucks, but maybe that's a safer bet, right? So no, we have not borrowed to invest. What I done, this was before I met my wife, was I did invest in these like leverage ETFs, right? So we leverage bull ETFs and leverage bear ETFs, where I was playing like 2 times, 3 times. So back in days when I didn't know what I was doing, I was investing in natural gas ETFs, and I was investing like these ultra 3 times bull natural gas ETF, thinking the natural gas price will go up because it's winter time. But obviously, I didn't know what I was doing. So when things were going well, I was getting 3 times my return. But when things weren't going well, I was losing my money pretty quickly. And then to kind of compensate, I was kind of playing both the bull and bear 3 times ultra ETF. So trying to kind of balance out my gain or loss, but I just couldn't time it perfectly. So that was my experience, so-called leverage. But yeah, I think generally speaking, leverage, you just need to know what you're doing. And like Nelson, you said, really come up with a strategy before you start borrowing to invest, and really think about the strategy you're deploying. When I think about leveraging, it's one thing, borrowing money to invest in stocks. I talk about defense stocks, but when you're borrowing money to invest in crypto, that's very, very risky because the volatility of cryptocurrencies. But some people even go one step further. They borrow to do option trades. So in options, you could buy calls and puts. Basically, calls are you think the stock will go up, right? Puts are when you're betting the stock will go down. Now, the thing with options is that options are a little bit different than stocks. Essentially, you're trading stock price, but the difference between options, you're playing with both the stock price and also the time. There's always an expiry date to an option. So you're playing with two variables instead of just one variable with stock. And if you're doing options and you're not borrowing to invest, those are called covered calls or covered puts. Essentially, you're only you have the money to cover your rear end. But some people don't, and they do naked calls and naked puts. And those are extremely, extremely scary, and you could definitely lose a lot of money. Now, you gain a lot of money, and it's very, very exciting. But when things don't go your way, you could very quickly lose a lot of money. So yeah, I think leveraging is something people need to really consider. Like what Nelson, you said, maybe don't do it all the time. If you're thinking leveraging, say looking back, like say financial crisis, right? When the market tanked by, I don't know, 30-40%, or even during COVID where the market tanked, maybe it makes sense to borrow a little bit of money to bet the market will recover. But again, you never know when the bottom of the market is. So just because you could borrow some money and invest when the market seems low, market could potentially go down another 10, 20, 30% or even more. So yeah, it's tough when you leverage because you could get caught very easily.
The options plays are really what makes me nervous because I see a lot of young investors who have decided that these are kind of their key to riches. And ultimately, a lot of option strategies, they're either kind of lottery tickets, which is, you're buying a low cost call option, which gives you this right to buy shares at a lower price. And basically you're speculating that the share price is going to go up in a hurry. And if that happens, then the option has all this built-in leverage in that. So the option will go up much, much faster than the share price. But the, of course, issue with that is that so you buy a call on, say, I don't know, Microsoft stock, and it's like, okay, I think this is going to go to this huge high amount, like $2,000 a share, and I'm going to pay this very low option premium to do so. So what happens is if Microsoft shares don't do what you think they're going to do, and they don't go up that much, your option expires worthless. So basically, you've spent money on a lottery ticket. And when you spend, $6 on a lottery ticket, it's just fun and who cares? But if you start spending chunks of your portfolio on these lottery tickets and they don't pan out, all of a sudden you end up losing chunks of your portfolio, or you borrow money to buy these options. And that's even worse, because the debt is still there. If the option expires worthless, the debt, it doesn't go away. The option is worthless and you still have to pay for the option premium. That is really bad. But of course, the thing that really scares me is the strategies that create obligations to buy something at a certain price in the future. So you sell a put that creates, you get money immediately, but you get this obligation in the future to buy something at a certain price. That's the kind of stuff that would keep me awake at night if I was a options investor. So yeah, Bob, what do you think about these kind of like naked call, naked put strategies? What would your advice be to somebody who thinks that they've sort of cracked the code here and that this is their path to getting wealthy?
Yeah, I think again, last time I checked, none of the Fortune 100 richest people made their money via stock trading. I guess Warren Buffett did, but he's been very, very consistent, right? If you could time the market and if somebody cracked the code how to time the market to get rich, there would be consistently that top 100 richest people list that Fortune puts out every single year. Now, here's the story, right? I mentioned I worked in high-tech company years ago. I remember my company, we put out quarterly results like one day and everything looked really good. Like obviously we were in a blackout period, so nobody in the company with inside information could trade during the blackout period. But we were above the guidance, like midpoint of the guidance. We were actually above the guiding range. The ESP was over. Everything was above the anticipation, and even the future guidance was good. But guess what? The stock, I think, tanked by 15% that day when the quarterly results came out. And I distinctly remember I was in a meeting with my boss, and we just happened to have our CEO and CFO step into the meeting, and we're scratching our heads, and we're just like, what happened to the company stock? Like, we had just had a fantastic quarter announcement, like, what went wrong? Why did the stock went down by 10-15%? And I kid you not, both the CEO and CFO were just like struck, like, we have no idea. Right? So that tells you a lot in terms of even like the CEO, CFO who know like the financial numbers of a company, and as a public traded company, there's stocks in both TSX and NASDAQ. They couldn't predict the stock would go down by 10-15%, despite a fantastic announcement, right? So when you're trading options, Nelson, like even if you have like you shouldn't have any inside information, but even you believe in a stock that will go up, it's so hard to predict. You're essentially playing with a lottery ticket. Now, if you're playing options, trading options with the money you have, sure, that's fine. That's like playing the lottery. That's fine. But when you're playing trading option with naked calls and naked puts, meaning you're borrowing to take on these calculated risks, I would say it's not even calculated, just risk in general, it's just not worth it, right? So sure, you can make quite a bit of money, but you could also lose a lot of money. So I think my general recommendation is don't do it. If you're going into options, trade options with money you have. Don't borrow money to trade options. Because options are the fact you're playing with both the stock price and the time, the expiration date. It just makes things so complicated and very, very hard to predict how things will go. Like with stocks, if the stock price goes down a little bit, you could just not sell and then hold it until the stock price recovers. But with options, if the option expires, you can't just hold on to the option and keep holding on. Right? It doesn't work that way. So yeah, that's my 2 cents on naked call and naked puts.
For me, it all comes down to downside. The upside is, everyone knows the upside. That's the whole reason why people are in these risky plays, because you have the ability to make 100, 200, 500% if earnings work out in your favor, and you can make all that money in a short amount of time. And I understand the appeal of that. Of course, that's appealing, but good investing comes from protecting yourself on the downside. And these options have zero downside protection. Bob, you talked the story about the company's earnings and how everything went right, and yet the stock went down because, and we've seen these stories before where like the CEO says something sort of bearish on the conference call and the stock just gets hammered after market. I don't know that that's what happened here, but the point is that these option plays, you can get everything right, and then something happens, whatever, and you've lost your shirt based on some stupid comment that the CEO made. For me, that's not investing, that's just speculating. And like you said, there aren't a lot of speculators in the Fortune 100, Forbes 100 richest people list, because speculators eventually get burned. If you flip a coin enough times, even if it's weighted properly, in terms of if it's weighted in your favor, you're still going to end up with the wrong flip. And because that's just the way it is. You just get unlucky sometimes. And you get unlucky in a group or even just once or twice if you use enough leverage, and that's it. You're wiped out. So just really minimize on the downside. But what I want to ask you is, there is a way to use leverage to invest. And it's something that a lot of Canadian investors have done successfully over the years. And that, of course, is the Smith maneuver. And unfortunately, it's not named after me, even though my last name is Smith, but I'm going to take partial credit for that. So what's so appealing about the Smith maneuver? Why does the Smith maneuver work when it doesn't work so well in terms of leverage? Why leverage doesn't work so well for so many investors? What's the difference there? And I have some thoughts maybe after you're done, because I think there is one thing that really separates that from everything else. So what are your thoughts on the Smith maneuver? Why is it so successful?
Yeah, I think Smith maneuver, basically, when you boil down to it, you're taking on a loan on your home equity. Right? You're taking on home equity loans, and then you're using that money to invest. And here in Canada, typically you can write off your mortgage interest, but when you're taking a home equity line, and you're using that to invest, you could write off the interest. So that's where people have done well. Canadians have done well using that strategy. And really the key point here is the interest rates are typically not anywhere as high as when you borrow money from your discount brokers. So we didn't even talk about the interest rates from these discount brokers are charging. Right? We're only talking about the margin calls. And when you take out a home equity, like take out equity from your home, there's no that margin call typically. So it's usually you take out, I don't know, like say $20,000, $50,000, and you have sometime to pay it back. It doesn't, there's no margin call gets triggered if the market goes down like 10, 15%. Right? So that's where you have a little bit of protection that way compared to borrowing money from your discount brokers. Nelson, your thoughts?
I think there's two things that really separate the Smith maneuver in terms of why it's worked so successfully for people. And the first one is kind of, you touched on a little bit, is the home equity line of credit versus borrowing from the discount broker. But I think that's really powerful, not so much because of the interest rate. The interest rate definitely helps, but I think that it helps you avoid a leverage situation where they're calling in the loan. So you're avoiding that kind of dreaded market call. And that's so important because when stocks go down, you don't want to be forced out at that wrong time. And it's the HELOC, the home equity line of credit, avoids that future. Now, there is the possibility that your bank can come along and say, hey, we're not going to lend you this money anymore. You have to pay it back, which happens sometimes, but the risk of that is far less than the risk of a margin call. So I think that's number one that's important. The other thing that's important is that the CRA has determined that in order for the interest to be tax deductible, there has to be some expectation of income, whether it's now or in the future. So essentially, the Smith maneuver is almost exclusively used for investing in dividend stocks. And the dividend stocks create this cash flow that is then used to pay the interest on the loan or to, like eventually start working on the principal of the loan. So essentially, it's a borrowing to invest strategy that is far less risky than a lot of the other borrowing to invest strategies that we've talked about today. And I think you put those two together and it makes the Smith maneuver this way of borrowing to invest that has way less risk than normal borrow to invest strategies. And I think that's why it's has such a great record of success, because it inadvertently creates this situation where, yes, you're taking on this risky activity, but it's way less risky than what it could be. Any other thoughts on the Smith maneuver, Bob?
Yeah, no, I think you you hit nails right there in the head with those 2 points. Yeah, like the income producing part is very important. By investing in dividend paying stocks to produce that income, so you can write off the interest or deduct interest, gives you a little bit of safety, right? Because typically dividend stocks do not have as big volatility compared to some of these non-dividend paying stocks. I'm kind of comparing to tech stocks typically. So if you invest in like the Canadian banks or utility companies, they don't have as big of a swing compared to say Meta or Tesla or Amazon. Now that brings to a point that I just thought about is that there's it's one thing about borrowing to invest and using options and so on, but it's also about using money that you don't need in the next, say, 5 years, or essentially don't invest with money that you need in the short term, right? So imagine if you are looking to buy a house or a property in the next 2 years, you don't want to be investing without potential down payment because you don't want to have to force to sell when the stock market is tanking. So look back, like during COVID, right? Like imagine if you had, I don't know, $50,000 that you were saving out for, say, a down payment of a property, or even $50,000 you save out to buy a car because you want to buy a car with cash. But instead of putting that money aside on a savings account or GIC or whatever that's safer, you decide to invest that money in the stock market. And it happened to be March 2019 where we're at the lowest of the low during that COVID time. You no longer have 50,000 on your hand, and because you need money, you would be forced to sell and take a significant amount of loss. And that's why you only want to invest with money you probably don't need for the next, I would say, 5 years, or maybe longer if you can. Definitely don't invest with money in the short term, because you want to be able to ride out any market volatilities, any market downturns. Right? You don't want to be selling or forced to sell when you don't have to. And that's one thing about managing risk when you invest is how can you avoid selling when you don't have to, right? How can you ride it out? That's one thing about mitigating risk when you invest.
Yeah, that's great advice. And in fact, I would take it almost maybe a step further and say that if you're saving up for a house or a car or whatever, I would not do anything with that money except keep it in a savings account. I wouldn't even put it in like a bond fund into the market or like a 60-40 portfolio or something that's, quite low risk, because you just don't know what that timing is going to kind of do for that money. And it could end up where you just end up being forced to sell at the exact wrong point, or it could be the point where it's like, hey, I'm ready to buy a house, but guess what? My, down payment has gone from 20% of my to, 15%. And then that opens up all sorts of bad possibilities. You have to get CMHC insurance, which costs you, and so on. So it's just keep that money in a savings account. You can move it around in terms of, like you can shop the various high interest savings account. They have promos, and you should be able to get kind of like 3% on it, which is a decent return on your cash. And just really, really be careful on money that you need, even if it's 2 to 3 years down the road. Anything can happen in 2 or 3 years. Bobby talked about the COVID market in March 2020. I remember in January 2020 when nobody was talking about COVID. It was like it wasn't even on anyone's radar. And then 2 months later, it destroyed the market. That's how quick things can change in terms of,
it was
that.
And it's just 2020. I think I may have said 2019. But yeah, that was so scary because it went down significantly in a very short period of time. And if you need money, you're kind of screwed.
Yeah, there's a Warren Buffett quote that I want to share because most Warren Buffett quotes are excellent, but this one I think just really sums up this episode just really well. And the quote is, "It's insane to risk what you have and what you need in order to obtain what you don't need." And, this talks about, in terms of, your retirement savings and just taking risk in that. So if the point is to get rich in a hurry, then you're risking what you have today and what you need for some future outcome that, if everything works out, tickety boo, everyone's just incredibly happy. But if it doesn't work out, it's not, you can't just shrug it off at that point. You're risking the important, the foundation of your portfolio in order to gamble with options or gamble with crypto or whatever. It's so incredibly dangerous to do that. It's one thing, we talked about the lottery ticket metaphor there. It's one thing to have a little bit of fun money and to go with that. I'm not an advocate of that, by the way. I think capital is precious and you should never waste, even if it's 1% of your portfolio, like looking at moonshots. No, don't do it. It's all precious, from my view anyway. People might disagree, but it's so dangerous to risk the bedrock of your money. Like, that's your family's money on these risky plays, whether it's the options or crypto. And by the way, I'm going to seg into my view of crypto, which is that I think it's evil. And if I was in charge of the world, I would ban it. I would ban it tomorrow. There's too many bad actors. It encourages too much bad activity. And I just think that there's zero benefit. It's just this way to speculate on bullshit assets that there's no gain to society by having these products out there. And it's a huge net negative to society to have people risking large amounts of their own money that they need in order to play these. Sorry, that's just my rant. Any thoughts? Any follow up on that?
I think the idea behind cryptocurrency is good. I mean, the technology behind it makes sense to me, but I don't even know how many cryptocurrencies there are in the world now. And I just discovered there's a crypto that's called Farcoin, which is like, with that kind of name, like, how can you even take it seriously? Like, I don't know. It just blows my mind. People are risking their money left, right, and center with crypto. And yeah, sure, you could make a lot of money, but you could also lose a lot of money. Now, Nelson, you did say that you're not willing to invest any, 1% of your money in these high volatile assets. But really, if you, like, my thought on that, and I'm a little bit different than you, Nelson, is that I believe you are looking to invest in these high risk assets, say crypto or tech stock or, even options. Obviously, don't borrow to invest. That's rule number one for me. But rule number two would be minimize the amount of risk you're taking on. So don't invest 100% of your portfolio in these assets. What do I mean by that? Maybe limit to, say, 10% of your portfolio, even 5% of your portfolio. Right? That way, if 5% goes down to zero, you're not losing your pants. The danger is so many people invest in crypto or tech stocks with 100% of their portfolio, and when things go bad, they lose a lot of money. But when you can limit your exposure, I think that's one way to manage your risk. And that's something we have done, even though we're investing in both dividend stocks and index ETFs, essentially hybrid investing. A very, very small part of our investment portfolio goes toward these tech stocks. Right? So like Amazon, Tesla, Nvidia, etc. And we're limiting our exposure such that if we see like a 10%, 20% drop, we're not going to lose sleep over it. And that's that's really a personal decision that we're comfortable with that exposure. Now, some people might not, so you might not want to do that. But if you are, I would highly recommend limit your exposure to these high volatile stocks or assets. So that's one way to minimize your risk.
Yeah, I'll clarify too that in terms of when I'm talking about these high risk assets, I don't necessarily think that, like an Amazon or an Nvidia or even stocks like Tesla or whatever are maybe necessarily in that bucket, because these are companies that have either the ability to generate cash flow in the present or the potential to do so in the future. That's not really what I'm talking about. Ultimately, I do invest pretty boring. Like I've said before, everything I own pays a dividend. I'm definitely more on the boring side of the portfolio. But in terms of the lottery tickets that I'm talking about, that's more like, crypto. I don't know what the intrinsic value of a Bitcoin is. I don't know. I don't think it ever produces any cash flow. So I can't value it. So therefore, if I can't value it, if I can't value that cash flow, then it doesn't belong in my portfolio. But saying that, most stocks that are on the stock market, there is the ability to try to predict that cash flow. So there's that aspect to it, And Bob, your thoughts on kind of how to minimize that risk in terms of keeping it at a lower part of your portfolio, I think that's great. So if somebody has, like 40% of their portfolio in the, NASDAQ 100, I don't really have a problem with that. It's a little bit too frisky for me. I don't do it, but at least there's actual assets there that in the future that should deliver some sort of cash flow. So just to clarify that, is that I'm not necessarily opposed to tech stocks. I'm opposed to kind of these highly speculative AI stocks that don't have any revenue today. I can't discount that going forward. I don't know what something like that's going to earn. I think it's highly unlikely that they ever earn enough to justify the valuation. So those are easy stocks to avoid for me. And in terms of your strategy, just, if you're going to speculate on those, fine. I can't stop anyone, but please don't do so using large amounts of leverage.
Right.
I think it's really about all the time we have. Sorry, Bob, just one more.
So
what are your last thoughts on this?
Yeah, I got a couple more points in terms of managing risk, right? So I mentioned, I mentioned about tech stock being risky. Yeah, you're right. Like they do have profit, but even more risky, riskier stocks would be penny stocks, right? Like those are highly volatile. You'll definitely watch out for those. Now, my last point would be, if you're working in a company where you get RSUs or restricted stock units, where part of your salary is comes in the form of company shares, I would caution about investing more money toward your company stock. Right? Why do I say that? Sure, if you're working in like Meta or Google, Amazon, these kind of tech stocks, it's easy to get sucked in and wanting to invest more of your money in the company you work for. But if you're part of your compensation already comes in the form of company shares, if you invest more, it's very dangerous, because if the company decides to cut you, you first of all lose your shares, because those RSUs don't mean anything until they're vested. 2 is you lose your source of income. And 3, if you invest a big amount of money of your personal money for your company stock, you also could lose that, because usually companies don't cut workforces until they're not doing well. So it's like double or triple whammy there. You'll definitely watch out if you're working in a company that are publicly traded. That's kind of my last point in terms of managing risk. Because when you have all your eggs in one basket, meaning all your money is invested in your company, like in the form of RSUs, your salary, and your own money, when things don't go well, it's very, very dangerous for you as an individual. So that's something to watch for.
Yeah, at the end of the day, one of the only free lunches in finance is diversification. And you're exactly right. You have to think about not just your portfolio, but you have human capital as well. Human capital is your ability to earn a living, is your, kind of your network, your ability to maybe get a job after you've lost your job. You have to factor that into your decision as well. And ultimately, it could result in too much exposure to one company, even one sector. I would argue is that it's maybe too much where, your paycheck depends on a sector. And then if your entire portfolio is in a sector or a company, your company stock, all of a sudden, if that sector has a downturn, and eventually every sector has a downturn, you are in a lot of trouble in terms of managing your risk. And if you combine that with leverage, with debt, you could be in even more trouble. So that's a really good point to bring up. Okay, that's about it for us this week. We appreciate all of your comments, your reviews, give us a 5-star rating, please, on Spotify, or the old thumbs up on YouTube. We appreciate all of that. And we see every one of your comments. We might not respond depending on, things, but we do see every one of them. Bob, any last thoughts?
No, it's been fun talking about managing risk, and looking forward to talk more.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.